Hello students! At this point, I have generally covered the lesson objectives of each of the 8 lessons within this course. Now I will provide content based on the textbook's objectives, which similarly highlight important concepts from each chapter. Today's objective is explain the importance of the economic environment to business and identify the factors used to evaluate the performance of an economic system. This live lesson focuses on textbook pages 16 through 23. Economic indicators are statistics that show whether an economic system is strengthening, weakening, or remaining stable. Examples of economic indicators include the gross domestic product and productivity measures such as trade deficits. The short-term pattern of economic expansions and contractions is called the business cycle. The aggregate output is the total quantity of goods and services produced by an economic system during a given period. An increase in aggregate output is an economic growth. When output grows more quickly than the population, two things usually follow. Output per capita, the quantity of goods and services per person, goes up. Also, the system provides more of the goods and services that people want. The standard of living is the total quantity and quality of goods and services people can purchase with the currency used in their economic system. Gross domestic product, or GDP, refers to the total value of all goods and services produced within a given period by a national economy through domestic factors of production. GDP is a measure of aggregate output. Typically, if GDP is going up, aggregate output is going up. If aggregate output is going up, the nation is experiencing economic growth. Gross national product, or GNP, refers to the total value of all goods and services produced by a national economy within a given period, regardless of where the factors of production are located. While GDP and GNP usually differ by less than 1%, economists argue that GDP is a more accurate indicator of domestic economic performance because it focuses only on domestic factors of production. Another important term is GDP per capita. This reflects the GDP per person, as calculated by dividing the total GDP by total population. GDP per capita is a better measure than GDP itself of the economic well-being of the average person. Real GDP means that GDP has been adjusted to account for changes in currency value and price changes. If GDP is not adjusted, it becomes nominal GDP, which is GDP measured in current dollars or with all components valued at current prices. Finally, another term is purchasing power parity. This principle states that exchange rates are set so that the prices of similar products in different countries are about the same. Purchasing power parity gives us a much better idea of what people can actually buy with the financial resources allocated to them by their respective economic systems. Figure 1.4 on page 20 shows the common Big Mac index, or how purchasing power parity works in relation to a Big Mac. Productivity is a measure of economic growth that compares how much a system produces with the resources needed to produce it. If more products are being produced with fewer factors of production, the prices of these products will likely go down. As a consumer, you would need less of your currency to purchase the same quantity of these products. Therefore, your standard of living, at least in regard to these products, has improved. If your entire economic system increases its productivity, then your overall standard of living improves. Standard of living improves only through increases in productivity. Real growth in GDP reflects growth in productivity. Several factors inhibit the growth of an economic system, such as the balance of trade and national debt. A country's balance of trade is the economic value of all the products that it exports minus the economic value of its imported products. A positive balance of trade results when a country exports more than it imports. A negative balance of trade results when a company imports more than it exports. The United States is a debtor nation, as trade deficit was almost $400 billion in 2008. National debt is the amount of money that the government owes its creditors. The government must raise money through taxes or bond sales. I have included a link about the United States national debt. This website tracks the national debt to the penny. Stability is a condition in which the amount of money available in an economic system and the quantity of goods and services produced in it are growing at about the same rate. Stability is threatened by inflation and unemployment. Inflation occurs when widespread price increases occur throughout an economic system. Instability results when the amount of money injected into an economy exceeds the increase in actual output, so people have more money to spend, but the same quantity of products available to buy. People compete with each other to buy available products, and prices will increase. The higher prices will eventually bring the amount of money in the economy back down. It is important to understand that the processes are imperfect, so the additional money will not be distributed proportionately to all people, and price increases often continue beyond what is really necessary. We can measure inflation by measuring price increases. Price indexes such as the Consumer Price Index, or CPI, measure the prices of typical products purchased by consumers living in urban areas. Here I have included a short video from NBC News about the Consumer Price Index. It clarifies some of the issues surrounding this metric. Unemployment is the level of joblessness among people actively seeking work in an economic system. If wage rates get too high, businesses will respond by hiring fewer workers, and unemployment will go up. Businesses could raise prices to counter increased labor costs, but they won't be able to sell as many of their products at higher prices. Because of reduced sales, they will cut back on hiring, and once again, unemployment will go up. A recession is a period during which aggregate output, as measured by real GDP, declines. An example is the 2008 recession, which many of you may remember well, but not fondly. A depression is a prolonged and deep recession. An example is the 1929 depression, which lasted for over 10 years. I have created a small Check Your Understanding section, similar to the online presentations, to help you verify your comprehension. You can review the answers on the next slide with me. Thank you for watching today's video. Please reach out to me via the chat room or email if you have questions. And for the Check Your Understanding answers, they are 1. A. Stability. 2. Aggregate output. 3. Balance of trade. And 4. GDP, or Gross Domestic Product. Take care.